So you finally decided to invest, dreaming of wealth, freedom, maybe retiring early. But now your portfolio is bleeding red. Every time you check your app, it's worse. The news is screaming recession, crash, market meltdown. And you're wondering, should I sell everything, buy more, or just delete the app and cry? But here's the twist. What if this crash is your golden opportunity? What if this chaos is the exact moment that creates the next generation of millionaires? Sounds crazy? It's not. But to turn this mess into money, you need to understand why crashes happen, how to survive them, and how some people get rich while others lose everything. In this video, we're going to break it all down. Let's go. Section 1. Why do stock markets crash? First, let's understand what even causes a crash. A stock market crash is when prices fall fast and hard. But why does that happen? There are 3 big reasons: bubble bursts, bad economy, and black swan events. Bubble bursts. Think of a bubble like extreme hype. When stock prices shoot up way higher than they should because of excitement, not real profits, a crash becomes inevitable. A classic example? The dot-com bubble in the early 2000s. Everyone threw money at companies with .com in their name. When reality hit, over 400 internet companies collapsed. The Nasdaq dropped nearly 80% and took 15 years to recover. 2. Bad economy, tough policies. When inflation skyrockets, stuff gets expensive, people spend less, businesses earn less, and boom, stock prices fall. Central banks might raise interest rates to fight inflation, but this makes borrowing expensive, which slows down growth and panics investors even more. 3. Black swan events. These are unpredictable disasters like the COVID-19 pandemic, wars, or financial scandals. In 2020, COVID-19 wiped 30% off the markets in just weeks. That's how fast fear can crash everything. There are other factors too, like margin calls, excessive debt, and herd behavior. But these 3 are the major crash triggers. Section 2. Are stock market crashes normal? Yes, they're completely normal. The stock market moves in cycles, up, down, sideways. It's not a straight line to the moon. Here are the types of market dips. Pullbacks, 5-10%, happens almost every year, totally normal. Corrections, 10-20%, happens every 1 to 2 years. It's the market adjusting overpriced stocks. Bear markets, 20-40%, happens every 5-6 years, usually tied to economic issues. Crashes, 40% or more. Rare, but major events like recessions or disasters can cause these. History proves that after every crash, markets recover, often stronger than before. 1987, market dropped 22% in a day, recovered in 2 years. 2008, crashed nearly 50%, recovered in 4 years. 2020, crashed 30%, recovered in just 4 months. So should you worry? So who lost money? Those who panicked and sold, and who made money? Those who stayed calm and held strong stocks.